The Federal Reserve delivered its latest monetary policy announcement with the central bank hiking rates by 75 basis points. The Fed's messaging was very confusing because Fed Chair Jerome Powell seemed to completely contradict the Fed's initial written statements. Now, the pleasant surprise in the written statement was that going forward, they will consider the lag effect of market impact on past rate hikes. Now, the markets interpreted these comments as dovish, which indicates a slowing down of the number of future increases. And within a few minutes, both the stock and the bond markets began to rally. Then Powell stepped up to the podium and surprised the markets when he said it would be premature to begin even discussing when the Fed might slow down future rate increases. A complete contradiction of the Fed's written statement. And this single spoken sentence from Powell caused a complete U-turn in the bond and stock market rallies, and both markets began to sell off. So the 10-year Treasury bond yield over the last 2 business days has seen a low of 3.92 and a high of 4.22, a 30 basis points change in yield in less than 24 hours. And all of this volatility was driven by the market's attempt to understand the Fed's messaging. Ultimately, I believe we will have clear direction of mortgage interest rates within the next 30 to 60 days when inflation data comes out. Either inflation begins to decrease or it doesn't. If we see a trend of decreasing inflation, then we will see a decrease in mortgage rates. However, if the Fed cannot get control of inflation, then we are heading toward higher rates over a longer period of time.